Thank you for being here. Could you tell us about yourself and your track record?
Yeah, hey, good chatting with you again here, Jasper. I'm an engineer with about 33 years approximately in the industry, doing pretty much everything from operations, completions, facilities, exploitation, BD, M&A activities. I've done pretty much all of it. I mean, the only thing I never did throughout my time is been a true drilling engineer. I started my career in the field for approximately 5 years. Great place to be, right by the wellhead from the ground up. You just a good learning environment when you start there. Even on the engineering side, I was in the field for quite a few years. But I've been working in Calgary since 1997 for a bunch of different companies, including. Originally, actually, I was in the field with Pan-Canadian Petroleum, then Renaissance Energy. I moved to Calgary to work for, which sold to Husky. I was only there for a short period of time. Then I went to a company called True Energy. They trusted in 2005, and we spun out our prior company, Vero Energy, in the same time in 2005. I think that closed in November of that year. So I started as president and CEO, along with Kevin Yakachuk, who's still with me today. He's vice president of exploration, and that's where we sit today. So half my career, I've been in the position of CEO, and over half of that as a senior executive of junior oil and gas companies.
Could you fill us in on the journey and success that you enjoyed with Vero Energy, which was the company that you ran before founding InPlay?
Yeah, Vero Energy was a good starting point. We announced that, I think, in August of 2005. By the time the deal closed, it was early November of 2005. Gas price, it was a lot of gas on it. We came up with about 600 BOEs a day. It was a bit of a fair amount of gas. I think 70% natural gas. Gas prices looked really good, and they really continued to go up into the spring of 2006. And even a little bit of up and down in 7 and 8. But in reality, it really peaked, of course, in 2008, just before the financial crisis, June, July. It peaked in the, I think, 11 NYMEX or 13 NYMEX, 11 AECO. Of course, WTI hit $140 some in that June, July of 2008 timeframe. Of course, just before everything came crashing down. So we took that company from 600 BOEs a day to peaked at 11,000 BOEs a day, predominantly with growth through the drill bit, organic growth, and a little bit of growth through through acquisitions, mostly tuck-in type acquisitions. And we ended up, like I say, we saw lots of ups and downs. Like I say, I got School of Hard Knocks on the business side of things with Vero, with the ups and downs and the financial crisis and the commodity prices, which ultimately we sold, give or take 8,000 barrels a day, just over 8,000, something like that, in January of 2012. And it was kind of a year like this year. It was actually even pretty warm. It was even warmer starting in January. And the natural gas was below $2 in January already when we sold that gas to a private equity firm backed by Pecos Warburg out of New York. And we just were left with about 1,850 BOEs a day of Cardium oil production. And we grew that to 2,850 BOEs a day by the end of 2012. And we ended up selling to a company called Torque Oil and Gas. And we sold it to Torque Oil and Gas after we gave a return of capital to our shareholders with the first sale. We sold to them for $3 a share. And they did a rollback of 5-1 over that time. And they ended up selling that to Whitecap in early 2021 for $3 a share. So, we sold it at the right time. If we maybe a year later, it would have been perfect, but we did sell it to be, at the start of a multi-year bull cycle, which went nicely into 2014 and early 2015. But it was a good win. Depending on when you bought and sold, just about anybody would have made money with Vero through that time frame.
You exited the gas first, which was timely, and then you exited your oilier assets. But so how did you know when to exit? Because you exited at a very timely or opportunistic time.
Yeah, again, you don't know for sure, but we knew you could see things coming on the gas side where it was going to be a tough year in 2012 for natural gas. But you never know the weather ultimately, which is the big drivers. But also, you get to 10,000 barrels. At the time, we grew fast, we grew hard, we had high declines. We had 40+% declines, which occurs when you try and grow too hard. And again, trying to even stay flat at 40+% declines in a lower commodity price environment was difficult. So, that's how we decided to make that move. And like I say, ultimately it was a 2-tranche move, but it boded very well for us and our shareholders with what we accomplished there.
Thank you for being here, Ken Leonard, and the newest addition to InPlay's management team. Could you introduce yourselves to the audience by telling us about yourself, about your career, including some of the experience you had when you built and operated the energy investment banking team at 8 Capital?
It's a pleasure to be on with you, Jasper, and happy to provide a bit of background on myself. I've spent 18 years as an investment banker, almost entirely focused on upstream oil and gas, based in Calgary, Canada. I was a co-founder of 8 Capital, which we founded in 2016, and we were Canada's largest employee-owned investment bank. So we were fairly transactional. I had the pleasure to work with some great partners and got to work on lots of great transactions. One of the things about being an independent is you don't have the benefit of a balance sheet as some of the larger banks do. So you need to be a bit more versatile and quite frankly end up being a little bit more active on the buy side, helping clients buy assets and making sure that they can finance it with the most attractive cost of capital. Some of the other aspects of an independent is, you got to be fairly collaborative. So, I was fortunate enough to formulate some pretty valuable relationships, both within the banking sector as well as within industry. So, I'm just hopeful that I can lend some of those relationships to InPlay to make sure that we're able to move the company forward and potentially look at some transactions.
What made you join InPlay out of all E&Ps?
InPlay has been a client of mine for almost 10 years. So I've known the team for quite a while. I think highly. I think we have the most talented team in the basin and some of the hardest workers. And, having had the chance to work closely with them, I had a good sense of the quality of the asset base and the opportunity set, and it was a natural fit, and quite frankly, it was an easy decision.
As a VP Business and Corporate Development at InPlay, what are your main tasks?
Yeah, I'd say probably 3 key tasks, and one is I lead the evaluation on acquisitions. It's a fairly active market in Canada with lots of assets that come up for sale, and we look at lots of them, and quite frankly, we have a pretty high bar in terms of evaluating, and it's got to compete with our own assets, and that can be difficult at times to find assets that are as high quality. The other piece would be optimizing and ensuring we have the most attractive cost of capital, both from the debt and equity side. So part of that is making sure that we're telling and articulating our strategy to the market. And formulating strategy would be the other piece alongside the rest of the senior management team, and whether that's organic growth, acquisition-based growth, return of capital strategy, all those pieces.
A large part of your role is to look for attractive acquisitions of assets or companies, etc. So could you describe InPlay's screening process for potential acquisitions and how you value these potential acquisitions?
For sure. The first thing we look at is asset quality. And when we think about quality, we look at the reserve life index, what the decline rate is on the existing production, and what the inventory looks like. And if we can't get excited about the quality of the asset base, the value doesn't really matter. We just probably won't look at it, because if the inventory doesn't compete for capital with our own drilling inventory, it's hard to justify spending time on looking at those kind of assets. So first off, we look at quality of asset, and if we like the reserve profile, if we like the drilling inventory, then we'll build up a fundamental NAV model. So we'll look at the PDP reserves. We'll formulate our own view on those PDP reserves, and then we look at the drilling inventory and what kind of a development program we would deploy within InPlay. We fundamentally look at that net asset value to come to a value, a preliminary value, and then we look at that relative to cash flow metrics and a free cash flow yield. And we got to think about how that will compete with others that may be bidding in the market, and then we apply a capital structure, whether a combination of debt equity to finance positions that we may be looking at, and we do want to ensure that we drive accretion for shareholders. So it's a pretty fundamental and full holistic view, and it's fairly detailed.
But when it comes to actual price of the acquisition, you buy it on a debt-adjusted enterprise value to cash flow basis.
I'd say it's more fundamental net asset value, but the other metrics we look at are enterprise value to debt-adjusted cash flow, and if we pay a certain price, is it accretive to our trading multiple? Would be a key piece that we look at. But we always look at fundamental net asset value first and foremost, and then back into what that equates to in terms of a cash flow multiple and a free cash flow yield multiple.
And in your screening process, you look at everything, be heavy oil up to natural gas.
We are probably we get more excited about oil assets than natural gas assets. We will look at heavy oil. It's not something that we have within the portfolio at the moment. We're all focused on light oil, but doesn't mean we won't look at it. There's some good opportunities and some good assets in this basin that are heavy.
Thank you. And with that, do you try to financially model exploration upside through increases in the drilling inventory?
Not typically. We are pretty reluctant to ascribe value to exploration. If we don't feel comfortable drilling a location within the next 6 months because of all the technical aspects are well defined, we won't ascribe value to those kind of assets. That said, it doesn't mean we don't expect that we will find more opportunity within assets that we look at that maybe we don't feel comfortable drilling that today. We won't ascribe value to it, but it doesn't mean we don't expect there to be more upside than what we necessarily ascribe value to when we look at assets.
Let's speak a little bit about the second half of the past year before we move into 2024. So could you summarize the second half of 2023?
Yeah, 2023 was an unprecedented year for any year that I've been involved with all the operational downtime that we had from early on in the year, from mid-February when we got 6 million a day pulled out of a gas plant, right through the year, like with the amount of turnarounds for third-party gas facilities and everything else. But ultimately, the second half of the year was definitely a lot better than the first half of the year. We still had some downtime. Of course, in Q2, we had the wildfires where we shut in close to 40% of our production for a time. So H2 was definitely better. We, of course, built our gas plant. We shut down that area in mid-September, and I think by the 7th of October we had it running full time. So a little longer than we expected or hoped for. Sometimes that happens when you use. We bought all used equipment, which probably saved us $5-6 million by doing that. But again, just makes your startups potentially a little more troubleshooting in the startups to make sure everything's running accordingly. So it was the second half of the year was a good year. I think we drilled around 8 wells. So that was a good part of what we did. Of course, Q4 is going to be the best quarter of the year for us, a strong quarter, which ultimately, it's too bad because we started losing the oil price. WTI started dropping off through November and December, and then ultimately our oil differential started increasing, specifically in November and December. So it was an interesting year for sure, but we're through that. And we're looking at 2024 pretty positively, where I like where WTI sits, and ultimately the differentials are looking like they're moving themselves into a good spot again to what's been more historic over the last few years.
Have the wells performed in line with your expectations? And with the wells, I mean the wells drilled in Q3 and Q4 last year.
Yeah, I mean, the wells have performed exceptionally. I think as we drilled 8 wells in the second half of the year, 4 of them exceeded our type curves that we use that are in our presentation. 2 were basically on type curve, and 2 were slightly below type curve, and that's pretty much normal for us. How that works, in the end, you have a bit of an average, but most of the time, we get 50% of the wells or better are performing over the type curve, and a bit of the majority of them are on type curve. So again, we had a successful program in the second half of the year, and we're going to follow up 2024 based on some of that drilling and those results. I think the big thing is we got 3 wells in Pembina we drilled in Q3 that came on in Q4. Very high oil cuts, starting out at 300 to 400 barrels a day of oil. They're still, we're 4 or 5 months in now, and they're still doing 150 to 100. I think just one's doing 190 barrels a day of oil. And the gas percentage there is only in the 20-25% range at this point. They start 10 to 15%, work its way to 20-25%. So those wells we're following up right now, drilling the 3rd well of a 3-well pad in that same area. So again, very focused on the oil production versus some of our higher gas-weighted areas.
You completed a second significant upgrade of a natural gas facility in Leafland, Wilston Green. What impact are you seeing on the production there?
Yeah, we doubled production from about 8 million cubic feet a day to just over 17 million cubic feet a day. We removed some compression, old, unreliable compression. So we put some new compressors in. We also put in a nice big refrigeration plant in there, and to remove the natural gas liquid so that the gas can make pipeline specs. So a couple things are, I think we went from 30 barrels a million to 40 barrels a million of liquids being removed at that facility, 30 barrels to 40 barrels per million cubic feet of NGLs. And secondly, it brought down our field pressures. And again, older wells are very sensitive to back pressure. And when you bring down all your pressure from your pipelines in your field, it ultimately affects all the wells. So we've seen declines specifically of the older wells, flatten out a little bit more and slightly less declines. Those are the key things that have occurred with the new gas plant. The other piece of that puzzle is it allows us to grow into the future in Williston Green with less issues around third-party natural gas facilities.
So let's start with production. So this year you're guiding. You have and by the way, for the viewers, InPlay has released guidance. So I recommend taking a look at that. So you're guiding for 9,000 to 9,500 BOEs per day, which 59 to 61% is liquids. Could you give a rough outline of how production will vary over each quarter or over the year, really?
Yeah, our production is we expect it to be probably the lowest in the first quarter of the year. Timing of drilling, we actually started drilling January 2nd, but we got the cold spell. Everything's behind by a couple of weeks, which ultimately isn't a bad thing because, of course, we're paying quite a bit higher differentials in the first quarter. Those 2 wells just came on in the last few days' production. The 3 wells we're drilling right now will come on later in March. And then we have a few non-operated wells that will be on in the second half of March too, which is, like I say, ultimately pretty good because we're seeing the differentials drop right now on the future curves from kind of $8 today to $4 in Q2 to give or take $3 in each second half of the year, which is what's showing up on the futures curve. So most of our production will be coming on late in Q1 into Q2, and hopefully we continue to have strong WTI prices, which I believe we will, and lower differentials. Q2, Q3 will be a very similar production rating, and then when we start drilling in either late Q2 or into Q3, we'll be bringing more production on through into Q4, and Q4 should be our highest production quarter of the year. So ultimately, I think the second half of the year is going to be a really, really strong year, a strong part of the year for us with a lot of free funds flow.
How much of that production would be pure light oil, approximately?
So, I mean, if you look at the mid-range of our guidance, we're probably about 43% light oil, which is, a 7% growth over 2023. Yeah, that's ultimately the answer.
Could you walk us through the drilling program for this year?
In the first quarter here, we're going to drill 5 wells in Williston Green. 3 of them are non-operated, about 0.65 net. And then we're going to drill 2 operated. We have drilled 2 operated wells in Williston Green that are 0.95 net, that we're 95% owners in those. That's the 2 that just came on. And then we're drilling the 300% wells in Pembina, following the 3 great wells we drilled late last year. So then we probably don't start drilling until at the earliest June after breakup. It might be into July, depending on a few things. Right now, that'll be the time we drill 3 Belly River wells. Then we follow that up with 2 more in Williston Green later, mid-late summer, and 3 more in Pembina in September through to early November time frame. That's the current plan, but things can change, but that is our current plan.
As you said, you're ramping up your activity in Pembina Belly River, and you will drill 3 wells this year. You drilled, was it 1 or 2 in Q4?
We drilled 1 in Q4 in a slightly different, like not in the main pool, just a little off of the main pool. But yeah, we plan on drilling 3 wells in the main pool this year, which is a follow-up to the 2 that we drilled in November of 2022 that very, very successful and very strong economic wells.
Awesome. And could you give us a summary of the operations at Belly River? I mean, how much production do you currently have approximately? What oil and gas, NGL split do you have, and an outline of the netbacks as well?
Yeah, so our Belly River, which is on the east side of the Pembina Cardium field, very east side, we've got about 630 BOEs a day. 90% of that is liquids, with 85% of that being light oil. Now, the Belly River is a very high quality sweet light oil. It actually gets a slight premium to the MSW differential, which we sell our product at. The Cardium gets a slight discount to the MSW differential. So again, very high quality oil. We have a full facility there. It's a high water cut play. So we have we have a facility to take the water out. We have pipeline infrastructures to gather the production, to send back the water and put down the injector well so it keeps pressures up in the field. So lots of fixed costs associated with that type of operation. So when we actually increase production, with the wells we drilled in the last year and a half, we've taken production from 360 to over 600, for a while over 700 BOEs a day. And ultimately, when you bring these new wells on with a high fixed cost, it helps every well in that field because you're dropping your fixed cost structure, and it adds life to all those wells. So yeah, looking forward to getting back on that program, and we should peak production there up in the 9 to 1,000 BOEs a day after we drill another set of wells through the summer here.
You have reduced your capex quite significantly compared to last year. Guidance is 64 to 67 million. Where does the reduction in capex come from? And as you're still growing production.
Yeah, so the biggest piece of the puzzle is just we have no major facility infrastructure projects. It's more of a normal year for the facility side of the business. The gas plant, the 2 gas plant upgrade expansions were somewhere in the $9 million range. We have some partners in there, so ultimately for us it was probably $7.5 million of capital. So that's all. The other piece in reality is we're drilling about 3 less wells this year than last year. Very focused, oil weighted drilling, and we're drilling instead of 17 wells, we're drilling 14, give or take, and we're drilling 3 Belly River wells, which are anywhere from $1.5 to $2 million less than the Cardium wells. So those are the big pieces where we've reduced the capital this year. Again, smart discipline. We came out with that program in January, and you're starting to see more and more of that across the board in the industry right now, of a really people focus towards capital efficiencies and a disciplined program this year.
Do you expect now that the most issues with, third party facility outages to have been resolved in the past year?
Yeah, well, so a lot of it there was third party outages, but there was also turnarounds. There was, every so many years, people need to turn around their facilities. There has been very little turnarounds in facilities since before COVID. A lot of guys, because the production dropped off and facilities were not run very hard. And then once everybody started bringing back production on in 21 and drilling and through 22 and 23, a lot of stuff kept getting delayed because everybody wanted to make revenue. But last year, again, not a great gas price summer. People planned turnarounds and some extended turnarounds. And so there was a lot of that. So based on the third parties that we use, there's a lot less happening this year from what we've all been told because it was such an intensive year last year. Secondly, our facility gives us a lot more leeway in the Wilson Green area. And the last part of that is, if you remember, in February of last year, we got backed out of a facility up in Pembina, backed out 6 million cubic feet a day on February 15th. And just due to declines of us and other producers going to that facility, it took us till pretty much into September before we got all that, the rest of that production back on. We have now signed a agreement to have priority one service where we'll never get backed out of that plant again. So we haven't drilled in that area since Q2 of 2022, or the well started in Q1 and came on in Q2 of 22. That's a very prolific area. It's a slightly gassy, but very, very high BOE a day wells. And we have not drilled there since then. We were planning on drilling there last year, ultimately, but then we got back out of the facility. We've solved that problem. And those are the 3 Pembina wells that we look to drill late fall, so it comes on into winter natural gas prices, which right now is double what on the futures market, what we're seeing today, for today's gas price and for summer gas this year. So I'm happy to be able to go back in that area because we've got lots to do there, and that's going to be a strong growth area for us.
How dependent is your drilling on the WTI price? I mean, say that you would become confident that the WTI would remain above $80 a barrel. Would you consider adding a few wells?
So, Jasper, ultimately, I don't see us adding any wells this year. Unless it's significantly above $80 WTI. Again, the name of the game is discipline. It's get the capital efficiencies up this year. It's keep the debt, the leverage low. And you're seeing it across the board. In fact, in the last 2 days, you're starting to see it with Permian drillers. You're going to see little growth in the Permian this year, if any, to be honest. And it had a big year of growth last year. All these guys are talking discipline, discipline, discipline. Diamondback bought Endeavor. They're cutting capital spending now. They're talking efficiencies. Like, why would I add more supply in an oversupplied market? The other piece of that puzzle is you drill too hard too quick, you get into that 40% decline range, prices come down. It's very difficult to keep production up or grow production when you have that 40% decline. So until we get into a severely undersupplied market, we're going to be a lot more consistent with our growth. Smart growth is how I'm going to call it, because we're focused on the oil part this year, because that's the commodity that's going to generate the revenues. And again, keep the debt low, low leverage, and return to the shareholders. There will be a time when you can do that, but right now it doesn't look like that. To me, is the time to get too aggressive.
What measures are you taking to reduce costs? So primarily operating, but also G&A.
Yeah, I mean, operating costs were tough last year with all the downtime. The facilities weren't the upgrades, so there was a lot of extra man hours in the field, affected op costs. We actually started seeing op costs dropping in the last few months of the year when we finally had stable runtime. Our facilities were running fully, and you're going to see that again this year. We're basically, it's still been an inflationary year in 23, specifically on op costs. I think a little bit on the capital, but not as much as the prior year, and then going into early 23. So we kept seeing operating third-party op costs due to inflation go up. I see all of that starting to come back down a little bit this year. I see drilling slowing down. after Q1 in Canada significantly. You're already seeing it with the gas guys talking about not doing anything hardly till fall now with the gas, pushing all their programs to later in the year. So you're going to have lower costs on the capital side. But on the operating side, we have not put out bids for a few years now because you just really had to use who you worked with prior, due to the fact that they didn't have enough people after COVID and slowly bringing people back. So you had to just make sure you got the companies that are available. But we're going to rebid everything out as we slow down in the second quarter here, right across the board. And I expect our op costs to come down, closer to where they were in 2022. Maybe a little bit higher with the inflation part, but I'd like to see our op costs below 14, back in the $13 a barrel range.
Playing into that, how much of your production is operated, and how important is operatorship for InPlay?
So, we operate about 85% of our production, and really, we control about 95+% of our drilling, completions, equipping side of the operations. And we believe we are at the leading edge on the technical side of what's going on in the Cardium, even the Belly River. So it is very important for us. We think we do have partners, and we do notice that our cost structures tend to be less than what the partners are drilling, completing, and tying in the wells are. Like I say, we have 3 non-op wells in the first quarter of this year. 2.2 or around 0.3 net, and then one's 0.35 net. So it's a smaller working interest, but ultimately, we are seeing that the cost structures from these operators are higher than ours, and not totally using the same sort of technology that we're using as well. So we believe it's important for us to operate and be in control of that part of the business.
Could you explain how much tax pools you have and how you're using them?
We have over 400 million of tax pools, with approximately 25% of them are 100% write-off. So ultimately, they're just used to reduce the revenue so that you don't pay any taxes. And we have not paid any taxes as a company to date. If you have higher prices for a longer period of time here, you could see us start to pay taxes. And also depends on how much you're putting into capital, because your capital, you're always continually adding tax pools on the development, tangible type equipment and things like that. So that's how we're using the tax pools. You're starting to see more and more companies, specifically in Canada, become taxable, and we have them in taxable for a long time. And Jasper, we won't, even if we pay taxes, we won't pay 23% just with our capital program. It probably would work out to be somewhere between, let's say, 11 and 15%, depending on the years. We'll continue to have pools that are 30% per year write-offs, tangibles 25% write-offs. So anyway, that's how that will work.
Okay, so if you spend, say, 100 million on property, plant, and equipment, you can use 25 to 30% of that to write off taxes? Or?
Yeah, per year, correct. So next year you're paying 25 to 30% on 75 million, or you're using 25 to 30% on the remaining balance. And then of course we're drilling, right? So we're spending 60 million of capital, which again typically is 25 to 30% pools. So you're continually adding on to that.
Yeah, as you said earlier in this call, so a headache that came up last year, the differentials, the MSW, we saw $9-10 per barrel. How are the differentials on the MSW?
Yeah, that was too bad, and that crept up pretty quick, because we, our best 2 months of the year were November and December, and of course we had that $8 to $10 US differential through that time frame. It crept up pretty quick. And we're starting Q1 with that similar type, let's say about $9 on average US MSW differential. I actually saw some spot prices for the rest of this month around the $6 range. But if you look at the futures market, we're showing $4 to $4.50 in the second quarter, and we're showing $3, and in some cases, depending on when and where, less than $3 for the second half of the year. Well, that's a great thing. WTI holds where it is. Our Canadian dollar stays weak. We get the diff coming back into more normality we're going to have a strong Q2, Q3, Q4.
On that topic, so WTI and AECO have been, they've been very volatile for the past year, really. So could you comment on this and give some insights into your thinking for this year regarding WTI and AECO?
Well, I mean, I'm structurally positive on WTI. I just read some information here yesterday from typically a very well-known source that's very accurate. And actually, the lady was in Saudi Arabia this week, Salima Croft, RBC New York, and there's a conference there, and her and a bunch of analysts were there for this OPEC show and tell and conference. And they firmly believe that OPEC Plus is going to extend the current cuts into Q2. So right now, I think we have a slight. I think supply is slightly less than demand. Demand is always a question mark, but it doesn't look like it should drop. Everybody's predicting it should continue to increase this year over last year. IEA, EIA, OPEC Plus all say that. So unless you have a severe recession, demand should increase. OPEC Plus is being very disciplined. Specifically, Saudi Arabia is being very disciplined. They've also said they're not going to grow from 12 to 13 million barrels by 2030 and spend the capital for that. They're going to use that capital for their Vision 2030 plan, which is diversifying their economy. And ultimately, I believe WTI is going to continue to work its way higher. Once we remove that remaining curtailed production from OPEC Plus, I think, we're going to be in a longer-term deficit program. And because of the lack of capital that has been spent, it's going to be difficult to make that up. So WTI, I'm very structurally positive. This year, I think there's a good chance we do average $80 for the year, maybe a little bit higher. Going forward, I think it'll be higher than that. Now, natural gas is a whole other story. You're starting to see people cutting back. We heard Chesapeake, the biggest gas producer in the U.S., is going to be cutting back 30%, I believe, for part of the year here in their capital programs. You're starting to see more and more. You're seeing the same in some of the intermediate gas producers in Canada. You haven't heard much from the larger gas producers in Canada yet, but I got to believe that they will cut back. I believe that they will. Once we get through the winter drilling program and you start getting to breakup, which should be early in Canada, mid-March, but by the end of March, the drilling will be done. You're going to see the rig counts drop off. You're not going to see natural gas rigs come back till probably late summer, early fall of any significant size. So hopefully that helps remove the glut that we have on natural gas storage in North America and in Europe. Europe's at 64% full right now for this time of year. Canada and the U.S. Pretty much at all-time highs for storage right now. And, March is generally looking warm. So we have a few months of let's see where things go. The saying is, how do you combat high? What's the best thing for high prices, high commodity prices? And it's high commodity prices. And generally the companies with the disciplined approach are reacting. So hopefully natural gas, you got 10, 15% declines in natural gas. And if you don't drill for a half a year, you slow the drilling right down, hopefully that brings it in line, the production down, and brings things in line and lessen storage. Even the growth in the Permian is going to slow down with the discipline you're seeing with the oil producers. So you're not going to get that associated gas, which has been a big part of the increase from 100 to 105 BCF a day of gas production in the U.S. So ultimately, it should start coming in line. I would hope by fall and going into winter, and that's why you're still seeing winter gas over $3 right now, still around $3 give or take. So
how's the thinking playing into InPlay's hedge book for this year?
Well, I mean, we're currently hedged about for the rest of this year 25% of both oil and natural gas. And our natural gas hedges, we have some collars and we have some swaps. They're all around $2 for summer gas, which is great. So they're all in the money right now. So it is only about 25%, but happy to have those in place. We got about 1,000 barrels of oil hedged, For the rest of the year, it's predominantly collars, and kind of got a ceiling of $82 and kind of floors in the $70-$74 range. So it's just they're there just to protect some downside because of the volatility that we see. Like last year, January when we put our budget, oil was $82 for the year. By the end of June, oil was $67. So just trying to eliminate a little bit of that volatility throughout the year, but that's where we sit, and we have, I believe, just a tiny little bit of hedges going into the end of winter, so the end of March last year, but not very much right now on the gas side.
Could you give us an update on the current state of the M&A market in Canada?
You're starting to see more M&A, but it's so far again, it's all on very large type assets and companies. We saw another one here. I mean, it's a Canadian company this week, Interplus, but most of its production's in the U.S. And they just they merged with a company here. You've seen again on the large side, you saw Crescent Point buying a private company, Hammerhead. You now see Chevron, who announced they're going to put up, I think it's 60,000 barrels of Duvernay assets in northern Alberta. Up for sale, but that'll take a few months. So you're starting to see activity. It's generally all on the large side. You're seeing a lot less activity on the small side. Mergers still haven't seen with the small companies. Even the assets. There was quite a few assets in sale in the fourth quarter last year, and I think if I remember, maybe one has closed. Right, very little is closed that I know of. There's some private stuff that happens, but again, access to capital is still tough, especially when you're in a bad sentiment market, which we have been, and that seems to be changing. You're starting to see stock prices creep up here again. But we're not seeing that. I do believe we're going to see more, though. It is coming. I can't put the time down, exactly. Look, we want to get bigger. I think people are starting to see that's required, and I do believe you're going to get more people thinking like we are. Sizes are more important. I think as balance sheets continue to get better, it's going to be easier to do deals. It's going to be easier to get lending sorted out with lower leverage companies. We're running at some of the lowest leverage as an industry that we ever have in our history. So, there's still a few outliers, but they're slowly working their way down too. So everything's lining up, I believe. So you will start seeing more type of activity in the next, year, 2 years. Ultimately, it's going to happen more and more, and hopefully coming down scale into the smaller assets and the smaller companies.
Where do you envision InPlay Oil in 2 years?
Well, look, our goal is to continue to create value with growth, but smart growth, right? I mean, hence why we're forecasting oilier locations this year, which is our revenue driver. And you got to remember, our oilier wells on a BOE a day basis are usually lower, right? So they're lower than when our gas wells, typically by 100 to 25 BOE a day in year one and down to 70 BOEs a day in the year two. But it's the smart growth because, the mid-range of our guidance is 7% oil growth. And that would be, at the top of our peer group for growth when you consider it just on an oil basis. And that's what I call smart, disciplined growth in this environment. And that's going to be pretty strong compared to our peers. The other thing that I look at is we want to get bigger. I think it's important to get bigger. You get more efficient. Things like G&A come down. You get more access to different debt structures as you get bigger. You get more, which the large guys do, because some of these big deals have been done predominantly with debt, right? And that's a big benefit. G&A comes down, like we're at high twos is normal for a company our size, an oily company. But as you get bigger, you start get that into the one. So, $1 a barrel extra of G&A going to the bottom line. So all these little efficiencies starting to work out. You got more buying power when you get services and buying steel and everything else. These are all important pieces of the puzzle. And you're seeing it in the multiples, right? And you're seeing it in typically from where we are on the junior side to the intermediates, they're getting a half a cash flow multiple to a full cash flow multiple higher. And in some cases, 2 cash flow multiples, in specific cases, higher than what you're seeing, in a very low leverage junior companies like ourselves. So that it's important to get bigger. You get more market cap. You're going to get more eyes on you. You're going to get generalist funds. There's not a lot of resource funds left out there. The resource funds, have disappeared because it was very hard to make a living in that through the 2015 to 18, and then of course COVID. So you're going to get more generalist funds, which I think is important, and they will come back because they have to show returns, and they will come back in our industry and start investing. If you didn't invest in oil and gas in 2021, you at some point, you were well below the curves, right? I mean, we were up 960% in 2021. We were up 35% in 2022. So if you were not investing, you would have been below the index by a lot. So they will come back. They need liquidity, market cap. All those things are important for most of these type of funds. So that's where we want to be. That's where we want to get to. And, like I said before, we're going to see more consolidation. We're going to see more consolidation. As you get bigger, more efficient, you can increase your free funds flow, your free funds flow yield. You can keep the leverage low. You should keep the leverage low, get better debt structures. But when you increase the free funds flow yield, that allows us to return more to the shareholders.